China and India just broke the silver market. You weren't supposed to see this. Have you ever considered what happens when a global market, one that has underpinned monetary systems for millennia, begins to fracture not on a trading screen but in the physical world? We are currently witnessing a seismic event in the precious metals space, a dislocation between the paper-derived price and the tangible reality of supply and demand that is so profound. It is being reported for the first time in history by some of the world's largest financial institutions and state-run media. This is not a story about daily price fluctuations. It is the story of a global run on physical gold and silver, a phenomenon that starts in the East and is now sending shockwaves across the entire planet, signaling a potential paradigm shift in how these foundational assets are valued. The prevailing economic condition we must first confront is the slow, grinding debasement of fiat currencies worldwide, most notably the United States dollar. For years, central banks have engaged in unprecedented monetary expansion, creating an environment where traditional safe haven assets are sought not just for profit, but for survival. This erosion of purchasing power has been the silent problem simmering beneath the surface of equity markets and economic forecasts. The opportunity, however, lies in recognizing the consequence of this policy, a flight to tangible assets that cannot be printed into oblivion. Precious metals have historically served this role, but the current scale of this movement is creating a market inefficiency where the price of a futures contract fails to represent the cost of acquiring the actual metal. The primary catalyst for this global repricing event is not a singular policy or innovation, but a massive, synchronized awakening in the Eastern Hemisphere. India and China, collectively representing nearly 3 billion people, are draining the world's physical supply at an astonishing rate. In India, a nation with a deep cultural affinity for gold and silver, we are seeing reports of the country's largest precious metals refinery running completely out of silver stock for the first time ever, driven by festival demand like Diwali. This is not a minor supply disruption. It is a fundamental breakdown in the supply chain's ability to meet organic, grassroots demand from a population that is larger than the United States and Europe combined. This is not an isolated event. In China, a nation grappling with its own internal economic and real estate market anxieties, the demand for a stable store of value has exploded. Reports from state-controlled media, specifically China Central Television, have confirmed that the area known as China's silver capital, responsible for a quarter of the nation's silver production, is experiencing widespread stockouts of silver bars. Online marketplaces, the modern equivalent of a public square, are showing physical silver trading at premiums that are multiples of the Western spot price. This is the free market at its most raw, signaling a desperate scramble for tangible wealth protection in the face of uncertainty. The tipping point occurs when these on-the-ground realities can no longer be ignored by the mainstream financial press and institutional players in the West. When a publication like Bloomberg runs headlines such as "Sold out in India," "Panic in London's," "How the silver market broke," it marks a critical juncture. This is the moment the narrative shifts from the fringe to the forefront. The problem is no longer a matter of interpretation by niche analysts. It is a fact reported by the world's most respected financial news outlets. This validation lends credibility to the underlying thesis of a physical shortage and forces the entire market ecosystem, from individual investors to large funds, to reconsider their positions and the true value of physical metal. Further cementing this tipping point are the pronouncements from behemoths like Goldman Sachs. When a pillar of the financial establishment begins to publicly predict that the United States could see a repeat of the Nixon-era price spike, it is a clear signal that the status quo is in jeopardy. They are referencing the 1970s, a period of profound stagflation where gold and silver prices experienced exponential growth, with silver moving from under $2 to $50 an ounce. For Goldman Sachs to invoke this historical parallel is not mere market commentary. It is an institutional warning that the same macroeconomic conditions, high inflation and stagnant growth, are re-emerging, and the potential outcome for precious metals could be just as dramatic. The immediate impact of this global scramble is a severe tightening of the physical market, even in the West. While major shortages on the scale of India and China are not yet the norm in North America, the early signs of stress are becoming undeniable. Anecdotal evidence from local coin shops across the United States consistently points to a dramatic shift in the buyer-to-seller ratio. Reports of 6 buyers for every 1 seller, depleted inventories of common bullion products, and the exhaustion of weak hands, who might have sold into previous price rallies, all indicate that the supply buffer at the retail level is rapidly diminishing. The people who wanted to sell have likely already sold, leaving a market dominated by determined accumulators. This dynamic creates a powerful feedback loop. As retail investors, the so-called sheeple, who were previously skeptical, begin to awaken to the realities of inflation and scarcity, even a small percentage of them entering the market can have an outsized impact. A local coin shop's inventory can be wiped out in a matter of days by a minor surge in local demand. As this occurs, it fuels a sense of urgency and perceived scarcity, driving more buyers into the market. This is how a slow, steady drain on supply can suddenly cascade into a full-blown panic, where the availability of the physical metal, not its paper price, becomes the primary concern for investors. The aftermath of this supply squeeze extends directly to the mining sector, the source of all new metal. Currently, the mining industry represents a historically low percentage of global equities, hovering around a mere 1%. During previous bull markets in commodities, this figure was closer to 10 or 11%. This gross underinvestment signifies a tremendous potential for growth. As the price of the underlying metals rises and the narrative of scarcity takes hold, capital will inevitably flow back into the mining stocks. The major mining companies, which have spent the last decade cleaning up their balance sheets rather than investing in new exploration and development, are now facing a pipeline crisis. This lack of investment in future supply means that the large producers will be forced to acquire smaller development stage companies to replenish their reserves. Companies that have spent years and hundreds of millions of dollars defining multi-million-ounce gold deposits will become prime acquisition targets. An influx of investment into this sector would not only benefit the mining stocks themselves, but would also bring more attention and capital into the entire precious metals ecosystem. This creates a rising tide effect, where increased interest in mining stocks reinforces the bullish case for the physical metals, further attracting more generalist investors into the space and amplifying the entire cycle. A crucial and often overlooked factor in this equation is the rise of a new demand vector, the tokenization of gold and silver. Regardless of one's opinion on cryptocurrencies, the technology of the blockchain is enabling the creation of digital tokens that are directly backed by and redeemable for physical gold and silver stored in vaults. This innovation is effectively bridging the gap between the digital finance world and the ancient world of hard assets. It is creating a new, technologically savvy class of precious metals investors who demand transparency, 24/7 market access, and direct ownership, bypassing the traditional financial intermediaries. The impact of this is already becoming significant. Tokenized gold products have recently crossed $1 billion in daily trading volume. This establishes gold not just as a static store of value, but as a dynamic, highly liquid trading and hedging instrument for the digital age. Unlike ETFs, which are bound by traditional market hours, tokenized assets trade around the clock, 7 days a week. This constant accessibility and global reach could unlock a wave of demand that the traditional markets were never able to capture. Each token created represents another ounce of physical gold or silver that must be acquired and vaulted, placing further strain on an already tight supply. In the coming years, we will likely look back on the advent of tokenization as a dark horse catalyst that fundamentally reshaped the precious metals landscape. It democratizes access to ownership on a global scale, allowing an individual in any country with an internet connection to own a fractional, verifiable interest in a physical gold bar held in a secure vault. This process removes friction from the market and appeals to a younger generation of investors who are native to digital platforms. As this market matures, it will constitute a persistent and growing source of demand that is completely independent of traditional institutional or retail channels, adding a powerful accelerant to the underlying supply and demand dynamics. The final piece of this complex puzzle, particularly for silver, is the often underestimated role of jewelry demand. While silver's industrial applications are well known, its use in jewelry constitutes a significant portion of annual fabrication demand, consuming hundreds of millions of ounces per year. This demand is not merely decorative. In many cultures, particularly in Asia and the Middle East, silver jewelry serves as a primary form of savings and a wearable store of wealth. It is a critical component of the grassroots physical demand story, representing a consistent and culturally embedded source of offtake from the market. As global wealth continues to shift eastward and the middle classes in nations like India and China expand, the demand for silver jewelry is poised for significant growth. Unlike investment bars and coins, which can be subject to speculative flows, jewelry demand is often more stable and less price-sensitive. This provides a solid base of consumption that underpins the market. The combination of burgeoning industrial demand from green technologies, record-breaking investment demand driven by monetary concerns, and this steady, growing demand from the jewelry sector creates a powerful trifecta that makes the long-term supply-demand case for silver particularly compelling. The ultimate takeaway from these converging trends is that we are in the midst of a fundamental repricing of precious metals, driven by a global loss of faith in unbacked fiat currencies. This is not a short-term trade, but a long-term re-anchoring of the financial system toward tangible assets. The physical demand from the East is the leading edge of this shift, exposing the fragility of the Western-dominated paper pricing mechanism. The panic is not yet widespread in the West, but the warning signs are clear, from the emptying shelves of local coin dealers to the stark proclamations of Wall Street's most influential firms. The future of the precious metals market will be defined by this tug-of-war between the physical and paper worlds. For decades, the paper markets of the COMEX and the LBMA have been able to dictate the global price, with relatively little concern for the underlying physical supply. That era appears to be drawing to a close. The overwhelming demand from nearly 3 billion people in China and India is a force that cannot be suppressed by futures contracts alone. As they continue to drain physical inventory from global vaults, the disconnect between the spot price and the price to acquire the actual metal will likely continue to widen until it forces a dramatic reset. This reset will have profound implications for investors. Those who understand the distinction between owning physical metal and owning a paper claim on that metal will be best positioned to navigate the coming volatility. The exhaustion of retail sellers in the United States suggests that the remaining holders are strong hands, unlikely to part with their holdings for anything less than a significant premium. This sets the stage for a classic supply squeeze, where a relatively small increase in demand meets an inelastic and unwilling base of supply, leading to a parabolic price movement. Moreover, the underinvestment in the mining sector presents a generational opportunity. As the world awakens to the reality that we may not have enough accessible gold and silver to meet future demand, the value of proven deposits in the ground will soar. The companies that own these deposits will become the new kings of the resource sector, attracting a flood of capital that could dwarf previous cycles. This will not be a smooth or linear process, but the underlying trend appears irreversible. Capital is flowing from the intangible to the tangible. The innovation of tokenization adds a powerful technological accelerant to this entire process. It is creating a parallel financial system for precious metals that is more efficient, accessible, and transparent than the legacy system. This will not only introduce a vast new pool of buyers to the market, but also increase the velocity of the metal as a transactional asset. A gold-backed token can serve as both a long-term store of value and a medium of exchange, restoring the monetary function of gold in a digital native format. This dual utility could unlock a level of demand that we have not seen in over a century. Ultimately, the lesson to be learned is one of history. Throughout human civilization, every experiment with fiat currency has eventually ended in failure. The current global system of floating, unbacked currencies is now over 50 years old, and it is showing signs of extreme stress. The run on physical gold and silver is not merely speculation. It is a rational response by hundreds of millions of people around the world who are seeking to protect their wealth from the certainty of currency debasement. They are trading their paper assets for real, tangible value that has endured for 5,000 years. As an investor or observer, it is crucial to look past the daily noise and focus on these foundational tectonic shifts. The reports of sold-out refineries in India and silver capitals in China are not isolated data points. They are the tremors that precede the earthquake. They signal that the foundation of the global monetary system is shifting beneath our feet. The physical market is asserting its dominance over the paper market, and the consequences of this power shift will reverberate through every corner of the global economy for years to come. This is a global phenomenon, and it requires a global perspective. The focus on Western markets alone provides an incomplete and misleading picture. The true story is being written in the bustling jewelry markets of Mumbai and the online bullion platforms of Shanghai. It is the story of a great wealth transfer, not just between asset classes but between hemispheres. The East is reaccumulating the monetary metals that flowed west over the past several centuries, and in doing so, they are fundamentally reshaping the global financial landscape. The implications for the future are staggering. A significant repricing of gold and silver would not just enrich investors in those metals, it would impose a new discipline on governments and central banks. It would act as a check on their ability to print money without limit and to finance deficits through inflation. This is why the battle between paper and physical is so significant. It is a battle for the future of money itself, a contest between the fleeting promises of politicians and the enduring value of a physical, finite asset. The convergence of these factors, unprecedented Eastern demand, awakening Western retail, institutional warnings, a starved mining sector, and transformative new technology, is creating the perfect storm for precious metals. The market is moving from a state of artificial surplus, dictated by paper leverage, to one of physical deficit, driven by overwhelming organic demand. This transition will be volatile and at times chaotic, but the direction of travel appears to be set. The history that is being made today will be studied by economists for generations. Looking forward, the key indicator to watch will be the premium between the physical price and the paper spot price. As this spread widens, it will be the most accurate barometer of the stress in the system. When refineries cannot source metal and dealers cannot restock their shelves, the paper price becomes increasingly irrelevant. The true price is what someone is willing to pay to get their hands on the actual ounce of gold or silver. That is the price being discovered right now in the markets of the East, and it is a price that will eventually have to be recognized by the entire world. The demand from the jewelry sector provides a crucial floor for the market, particularly for silver. It is a consistent source of consumption that is less affected by the speculative whims of financial markets. This industrial and consumer base ensures that even in periods of lower investment demand, there is a steady offtake of physical metal. This is a dynamic that is often overlooked, but is critical to understanding the long-term structural deficit that is forming in the silver market, where demand from all sectors consistently outstrips new mine supply. The potential for a 1970s-style stagflationary environment, as hinted at by Goldman Sachs, cannot be overstated. During that decade, the initial stages of the precious metals bull market were met with skepticism and disbelief, much like today. However, as inflation proved to be persistent and economic growth faltered, investors flocked to the only assets that provided genuine protection. The gains were life-changing for those who positioned themselves early. The parallels to our current environment are too striking to ignore, and the institutional recognition of this risk adds a significant layer of validation. The concept of the debasement trade is now entering the mainstream lexicon. It reflects a growing awareness that the greatest risk to wealth is not a market crash, but the slow, insidious erosion of the currency in which that wealth is denominated. Gold and silver are the ultimate beneficiaries of this trade, because they are assets that exist outside of the traditional financial system. They are not someone else's liability, and their value is not dependent on the full faith and credit of any government. This sovereign quality is becoming increasingly attractive in a world of unsustainable debt, and monetary experimentation. In conclusion, the confluence of events we are witnessing in the precious metals market is not a cyclical rally but a secular shift. It is a story of physical scarcity confronting a world awash in paper claims. The unprecedented demand from China and India is the catalyst that has exposed the fragility of the Western-centric pricing system. The awakening of retail investors, the warnings from Wall Street, the potential for a mining sector renaissance, and the technological innovation of tokenization are all powerful tailwinds. We are moving toward a future where the true value of gold and silver is determined not by futures algorithms, but by the tangible demand of billions of people seeking a safe haven from a failing monetary experiment.